Every year, India moves close to 500 crore tons of freight. That's roughly the weight of over 8 lakh fully loaded Boeing 747s. And this is only going to increase. By 2032, India is expected to become a $10 trillion economy, which means more factories, more consumption, more exports, and naturally, a lot more goods moving across the country. But most investors don't think about logistics. They either see it as trucks and warehouses, or they just know one or two well-known companies. But logistics is much bigger than that. It's one of the largest and fastest growing sectors in the country, yet it's still one of the least understood. And that's exactly why we spent hours breaking this industry down so you don't have to. Hi, I'm Aparna, and in today's video, we'll first understand how big this opportunity really is. Then we'll break down how the logistics industry actually works, because once you understand the industry, it becomes much easier to understand the companies. And finally, we look at the 6 listed companies across the different segments of logistics, each solving a very different problem. So let's get right into it. Whenever an economy produces more, consumes more, or exports more, one thing that automatically increases is freight movement. That's why it is actually considered one of the best indicators of economic activity. Today, India moves around 500 crore tons of freight every year. By 2032, it is expected to reach almost 800 crore tons, which means India's logistics industry, that is currently worth around 22 lakh crore, could grow to more than 32 lakh crore. But as investors, the real question is, which companies actually benefit from this growth? To answer that, we first need to understand how the logistics industry works. Think about the last product you ordered online. Before it reached your doorstep, it went through multiple stages. It started at a factory, then it traveled by road, rail, ship, or air. It was then stored in a warehouse, sorted, packed, and moved again. And if it came from another country, customs and container handling were involved. If it was a medicine, it probably traveled through a temperature-controlled supply chain. And finally, someone delivered it to your doorstep. That's the logistics value chain. Now, if you look at it from the business side, not every business has the same logistics requirement. An e-commerce company cares about speed, a pharma company cares about temperature control, a steel company wants the cheapest way to move heavy cargo, an LNG importer needs specialized storage and handling infra. They are all part of the logistics industry, but they are solving completely different problems. So over time, companies realized it didn't make sense to manage all of this themselves. So they started outsourcing different parts of the supply chain to specialists. Some outsource only transportation, others hand over transportation, warehousing, and inventory management to a single partner. That's what we call third-party logistics, or 3PL. Some companies go one step further. They don't own trucks or warehouses themselves. Instead, they use technology to manage the entire logistics network. That's known as 4PL. And that's exactly why listed logistics companies look so different from one another. So instead of looking at logistics as one industry, let's break it into 5 different segments and understand the companies leading each one. Mahindra Logistics. Let's start with the 3PL, or third-party logistics segment. This is where companies outsource a large part of their supply chain to a specialist instead of managing it themselves. One of the biggest players in this space is Mahindra Logistics. It manages almost every part of the supply chain for its customers, from transportation and warehousing to freight forwarding, in-factory logistics, B2B express delivery, last-mile delivery, and even employee mobility. Today, it operates over 600 locations, covers 19,000 plus pin codes, manages 19 million square feet of warehousing space, and delivers more than 1 crore packages every month. For a company with a market cap of around 4,000 crore, that's a sizable logistics network. But what makes it interesting right now isn't its size. It's the turnaround story. Over the last year, management has been focused on one thing: profitable growth. The biggest challenge for them has been Rivigo Express, their B2B express logistics business, which has been dragging overall profitability. Management believes this business can reach EBITDA break-even by FY27. At the same time, the company is expanding into faster growing areas like e-commerce, quick commerce, and express logistics. It's also investing in Logi1, its digital platform that gives customers real-time visibility across their supply chain while improving operational efficiency. Another important target is warehousing. They want to make 95% of their previously idle warehouse space productive by September 26. And they've already started adding new customers across e-commerce, manufacturing, and telecom. The turnaround is also visible in numbers. In FY26, revenue grew 15% to nearly 7,000 crore. EBITDA increased 33% to 377 crore, and the company moved from a 36 crore loss in FY25 to an 8 crore profit in FY26. But yes, there are risks. Nearly 60% of the company's revenue still comes from the Mahindra Group, and logistics is naturally a low margin business where higher fuel costs, labor shortages, or weak execution can quickly impact profitability. The stock currently trades at less than 1 time sales, which is why some investors see re-rating potential. But the real thing to watch is execution. Now let's move to a completely different part of the logistics chain. Not every product should travel by road. For heavy cargo like containers, steel, cement, or coal, rail is often much cheaper over long distances. In fact, moving 1 ton of cargo costs around 3.8 rupees per ton kilometer by road compared to about 2 rupees by rail, while coastal waterways are even cheaper at around 1.8 rupees. Air freight, on the other hand, is by far the most expensive at around 72 rupees. India is targeting $1 trillion of merchandise exports by 2030. That means more containers moving between factories and ports. And that's exactly where Concor comes in. It is India's largest container rail logistics company. It transports containers between ports and industrial hubs using rail while also operating inland container depots or dry ports where containers are stored, handled, and cleared through customs. In other words, Concor manages a large part of the container logistics ecosystem. At one point, it controlled almost 75 to 78% of India's container rail market, although now the competition has increased and market share is around 55%, but it still remains the dominant player. Management believes the upcoming JNPT Western Dedicated Freight Corridor could drive future growth by making rail transport faster and cheaper. For FY27, management expects export and import cargo volumes to grow 8%, domestic cargo volumes to grow 15%, and overall container volumes to grow around 9.5%. The company is also expanding into new opportunities. It's moving bulk cement through specialized tank containers, launching Aushadhi Express for pharma exports, growing trade with Nepal, participating in the Bharat Container Shipping Line, and investing around 900 to 1,000 crore every year to expand its network. Financially, it's one of the strongest businesses in the sector. In FY26, revenue stood at around 9,450 crore, EBITDA margins remained above 24%, and the company handled a record 68 billion kg, the highest in its history. But like every logistics business, Concor's growth depends on the broader economy, and competition from private operators is also gradually increasing. Today, Concor has a market cap of around 40,000 crore and trades at roughly 32 times earnings. So far, we've looked at moving containers and parcels. Now let's look at something much more sensitive: energy. Unlike regular cargo, LPG, LNG, and liquid chemicals need specialized storage and handling. And with India importing nearly 60% of its LPG requirement, this is becoming an increasingly important business. That's where Aegis Logistics comes in. Aegis owns the infrastructure behind the movement. It imports, stores, and distributes LPG while also operating storage terminals for petroleum products, chemicals, and edible oils. Aegis operates terminals across some of India's busiest ports, including Mumbai, Kandla, Haldia, Kochi, Mangalore, and JNPT. And that's its biggest strength. Unlike most businesses, these assets are very difficult to replicate. Building storage terminals near ports takes years of approvals, infra, and customer relationships. That's why Aegis has built long-standing partnerships with oil marketing companies backed by global partners. The company is also preparing for the next phase of growth. It's expanding liquid storage capacity at Mumbai and JNPT, setting up India's first independent ammonia terminal at Pipavav, and evaluating opportunities at the upcoming Vadhavan port. The financials also reflect this growth. In FY26, revenue increased 23% to around 8,300 crore, while profit after tax crossed 1,400 crore for the first time. Its gas division also reported record logistics and distribution volumes, and the company now has liquidity reserves of nearly 6,000 crore to support future expansion. But there are risks you should watch. Since the business depends heavily on global LPG supply chains, geopolitical tensions, shipping disruptions, or sharp movements in energy prices can temporarily affect volumes. The company also has a large expansion pipeline, so timely execution and utilization of these new assets will be very important. Today, Aegis has a market cap of around 45,000 crore and trades at roughly 52 times earnings. Now let's move to the largest part of India's logistics network. Around 65% of India's freight still moves by road. But road transport has one big challenge. The industry is highly fragmented. Most trucks are owned by small operators, which makes toll payments, fuel management, vehicle tracking, financing, and even finding the next shipment far less efficient than they could be. BlackBuck was built to solve exactly this problem. What's interesting is that BlackBuck doesn't own trucks. Instead, it has built a digital platform that brings together everything a truck operator needs in one place. The idea is simple. Instead of dealing with multiple service providers, truck operators can manage everything through a single platform. And the scale is already significant. Every month, more than 8.8 lakh truck operators use BlackBuck's platform. That's roughly 25 to 30% of India's trucking ecosystem. On average, active users spend 44 minutes every day on the app. The company also has more than 10,000 physical touchpoints across over 80% of India's districts. The biggest advantage of this model is operating leverage. Once customers start using multiple services on the platform, revenue per customer increases without requiring the company to own more physical assets. Management is now betting on two new growth engines. The first is Superloads, its AI-powered fleet marketplace, and the second is its asset-light vehicle financing business. If both scale successfully, they could become meaningful contributors over the next few years. The financial performance is also improving. In FY26, total income grew 55% to around 700 crore. Adjusted EBITDA increased 84% to 190 crore. And the company reported its first full year of profitability with PAT of 160 crore. But execution here also remains very important. BlackBuck currently has a market cap of around 9,500 crore and trades at roughly 55 times earnings. Now let's move on to the last segment, which is probably the one you've interacted with the most. Think about how online shopping has changed over the last few years. Not long ago, waiting a week for a delivery was normal. Then it became next day delivery, and today in many cities it's down to just 10 or 15 minutes. That's completely changed what customers expect. And as more people shop online, especially across tier 2 and tier 3 cities, the demand for fast and reliable deliveries continue to grow. In fact, the express and e-commerce logistics segment is expected to grow at around 14% annually. Now, delivering millions of parcels every day sounds simple, but it's one of the hardest logistics business to build. Every package has to reach the right customer at the right time and at the lowest possible cost. Let's start with one of the most important players here, Delhivery. Over the last decade, it has built one of India's largest integrated logistics platforms. Today, it offers express parcel delivery, part truckload freight, warehousing, cross-border logistics, and supply chain services all on a common technology platform. The company's goal is simple. It wants to become the logistics infra that businesses rely on no matter what they are shipping. One of its biggest recent moves was the acquisition of Ecom Express. This significantly expanded Delhivery's customer base, shipment volumes, network reach, and sorting infra, especially across rural and eastern India. And this matters because logistics is a scale business. The more shipments that move through the same network, the lower the cost of delivering each package becomes. That's a competitive advantage that's very difficult to replicate. The financials also show that scale is starting to translate into profitability. Services revenue reached around 10,500 crore, EBITDA margins improved from 4.2 to 7.3%, profit after tax stood at 347 crore, and the company generated positive free cash flow for the first time in 3 years. Technology is another important differentiator here. Today, Delhivery serves more than 18,800 PIN codes using AI-based routing, warehouse automation, and robotics to improve delivery efficiency. But there are risks. Competition is becoming more intense. Amazon and Flipkart continue to strengthen their in-house logistics networks, while Meesho's Valmo is emerging as another serious competitor. At the same time, management also has to successfully integrate Ecom Express. Today, Delhivery has a market cap of around 35,600 crore and trades at roughly 3.4 times sales. Now let's compare that with Shadowfax. Both companies operate in logistics, but they have chosen completely different strategies. While Delhivery has built an end-to-end logistics platform, Shadowfax has stayed focused on one area, last mile and hyperlocal deliveries. Its business revolves around quick commerce, same-day delivery, reverse pickups, and hyperlocal logistics. And that focused strategy has helped it build leadership in exactly those categories. Today, Shadowfax is India's largest third-party quick commerce logistics company, the market leader in reverse pickups, and one of the few players offering same-day delivery at a national scale. Its company now covers 16,372 PIN codes and is supported by 2.9 lakh active delivery partners. That scale is what allows the company to deliver quickly while keeping costs under control. Shadowfax has a market cap of around 14,000 crore and trades at roughly 3.5 times sales. So while both companies are benefiting from India's growing e-commerce market, they are building very different businesses. Now, before we wrap it up, let's take a step back. Why is all of this growth happening now? The answer is simple. India isn't just building more roads or ports anymore, it's building an entire logistics ecosystem. Projects like Bharatmala are expanding the highway network. Dedicated freight corridors are increasing rail freight capacity. Sagarmala is modernizing ports, and PM Gati Shakti is bringing all of this together by connecting roads, railways, and ports into one integrated network. And that's important because better infra lowers logistics cost, improves efficiency, and allows goods to move faster across the country. And when that happens, the companies operating on top of this network also benefit. That's why logistics isn't just a sector, it's an enabler of India's economic growth. Now let's bring everything together. We looked at 6 companies. Each of these businesses solves a different problem, has a different business model, and will benefit from India's growth in a different way. The real opportunity lies in identifying which part of the logistics value chain is likely to create the most value over the next decade. If you enjoyed this kind of deep business breakdown, let us know which sector you would like us to cover next. And if you found this video useful, don't forget to like the video and subscribe to the channel. I'll see you in the next one.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.